Imagine if you could have known the perfect time to buy during every major market crash of the last 20 years. The 2008 financial crisis, the 2020 COVID crash, the 2022 tech sell-off. What if I told you that some of the world's most successful investors use a specific set of indicators that have predicted nearly every major market bottom? Today, we're going to reveal these powerful tools that Wall Street would rather keep secret. Back in 2008, I watched in horror as my portfolio dropped 50%. Like many investors, I sold near the bottom, exactly when I should have been buying. That experience led me on a decade-long journey to discover what I'm about to share with you today. But first, let's address something crucial. Listen carefully. Nobody can time the market perfectly. The best strategy is to stay consistently invested through a diversified portfolio. But, and this is a big but, there are rare moments when the market practically screams buy. And when all the indicators I'm about to show you align, well, that's when fortunes are made. When these indicators all flash green, it's not just about buying, it's about buying aggressively. I'm talking about leveraged ETFs and yes, even considering low-interest loans. Sounds crazy? Let me show you the data. The first indicator is something we call the Reverse Psychology Index, the PY investing indicator. Here's what makes it fascinating. It's designed to be used backward. When it says, hold cash, smart money does the opposite. Let me show you something mind-blowing. Every single time this index has recommended more than 75% cash in the last 15 years, the market was near a major bottom, every single time. Take March 2020. The index screamed, 90% cash. Guess what happened next? The S&P 500 doubled in less than a year. But this isn't even the most powerful indicator.
First, let's examine the PY Investing Fear and Greed Index. This sophisticated indicator tracks market sentiment by measuring the percentage of stocks in uptrends relative to their 6-month exponential moving average. What makes this indicator particularly valuable is its contrarian approach. When it recommends high cash positions, that often signals prime buying opportunities. Consider entering the market when cash recommendations exceed 50% and look for aggressive positioning above 75%.
Warren Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." But how do you measure fear? Enter CNN's Fear and Greed Index. Think of it as the market's emotional MRI. It combines 7 different metrics: market momentum, stock price strength, market breadth, put/call ratio, volatility, safe haven demand, junk bond demand. When this index drops below 20, showing extreme fear, it's historically been like finding money in the street. But here's the key most people miss. You want to look for divergence.
The CNN Fear and Greed Index offers a holistic view of market sentiment through 7 distinct components. Think of it as taking the market's emotional temperature with readings from 0 to 100. It factors in market momentum, stock price strength, trading volumes, options activity, volatility, and both safe haven and junk bond demand. All components are weighted equally, providing a balanced perspective of market psychology.
When prices make new lows, but the Fear and Greed Index makes higher lows, that's your golden signal. This divergence has preceded some of the biggest rallies in market history. Now, let me introduce you to what I call the Market's Truth Serum, the BPNYA. This indicator shows you what's really happening beneath the surface. When it drops below 20%, it's like a spring being compressed. The bounce that follows can be explosive. But here's the advanced technique professional traders use. Watch for a cross above its 20-day moving average while still below 30%. That's when the magic happens.
Moving to the NYSI Bullish Percent Index, or BPNYA, we're looking at a technical powerhouse. This indicator becomes particularly interesting when it drops below 30%, signaling oversold conditions. When it dips further below 20%, that's your strong oversold signal. For advanced traders, combining this with the 20-day moving average and other technical indicators like MCD and RSI can provide even more robust trading signals.
But what if I told you there are 3 more indicators that, when combined with the first 3, create what I call the perfect storm setup? The NYSI is what I call the prophet. In the last 15 years, every time, and I mean every time, this index dropped below 750. A significant rally followed within weeks. It's almost scary how accurate it's been.
The McClellan Summation Index, or NYSI, is your trend strength indicator. Pay close attention when it falls below minus 750. Historically, this has marked significant market bottoms. Remember, this indicator operates on a fundamental principle. Most stocks move with the market. Its companion, the McClellan Oscillator, or NYMO, provides shorter-term insights. Watch for readings below minus 80, which typically occur just once or twice a year, signaling extreme oversold conditions.
Now, let me be clear. This isn't about day trading or getting rich quick. These are serious tools used by professional investors to identify rare opportunities for aggressive positioning. The NAMO is like having X-ray vision into the tech sector. When it drops below 80, it's historically been like finding tech stocks in the bargain bin. But here's the advanced technique. Look for what we call a positive divergence, when the NASDAQ makes new lows but NAMO doesn't follow. This has predicted some of the biggest tech rallies in recent history. Our final piece of the puzzle is the ITVMNAS, the volume indicator that shows you when sellers are truly exhausted. When it plunges below 100, it's often signaled that the smart money is quietly accumulating while everyone else is panicking. Now,
Finally, we have the intermediate-term volume momentum oscillator, or BPNYA. This sophisticated tool measures volume momentum and becomes particularly powerful when readings drop below minus 100, often signaling seller exhaustion and potential market bottoms.
here's where it gets exciting. When all these indicators align, when they all flash by signals simultaneously, that's what I call the perfect storm setup. This rare alignment has occurred only a handful of times in the past 20 years.
For optimal results, look for the perfect storm, when multiple indicators align to show extreme readings. This might include a PY investing cash recommendation above 75%, fear and greed below 20%, BPNYA under 20%, and other indicators at their extreme levels. However, remember, while these indicators have proven reliable historically, they should always be used within a comprehensive risk management framework.
Let me show you what happened the last 3 times these indicators aligned. 2009, market rallied 80% in the following year. March 2020, S&P 500 doubled in less than 12 months. October 2022, tech stocks surged over 40% in just months. When you see this alignment, that's when you might consider rotating into leveraged ETFs, 2x or 3x, using low-interest loans strategically, rolling options positions for maximum leverage. But remember, leverage is a double-edged sword. Never risk more than you can afford to lose. Use position sizing and always maintain strong risk management. Here's something most analysts miss. These indicators work best when combined with macro analysis. Watch for Fed pivot signals, inflation trends, market sentiment extremes, technical support levels. If you want to learn more about these indicators and get real-time updates when they align, hit that subscribe button and turn on notifications. In our next video, I'll show you exactly how to track these indicators yourself.
Remember, the biggest fortunes in market history were made not by timing the market perfectly, but by being aggressive when opportunities were greatest. These indicators help you identify those rare moments. Use them wisely.